Hey, this is Justin with Pack Tax. Today we're just going to kind of talk about itemized deductions, when they're applicable, when they're not, what we need to track. Before we jump into the specifics on itemized deductions, I kind of just wanted to talk through where do they sit in a tax return and why are they important. So, as we look at our taxes, we get down to a number that's called our taxable income. To get there, we start with all our sources of income, so our W 2s, 1099s, any self employment or rental income that we have. And we have certain adjustments that the IRS allows us, whether that's student loan interest or educator expenses, or in certain situations, we could look at like IRAs or HSAs. And then we get to the section that's deductions. And the IRS allows everyone to have a deduction on their income before their taxable income. And what that can look like is either we take itemized deductions or we take a standard deduction. And what we're going to talk today about is those itemized deductions. So as we look at itemized deductions or the standard deductions, there's some differences. Our itemized deductions are those actual expenses that we incur as taxpayers. There's different sources of itemized deductions, as you'll see on this list: medical expenses, state and local taxes, mortgage interest, charitable contributions are our most common that the IRS allows us to reduce our income by. But at the same time, we can also, instead of looking at those itemized deductions, we can take a standard deduction that's set by Congress and the IRS. And the amount of that deduction depends on how we file. And so for 2025, which is the tax year coming up, we're seeing that for single taxpayers, that standard deduction is going to be 15,000, and for our married filing jointly taxpayers, that standard deduction is going to be 30,000. We want to look at both of these options as we're filing our taxes and select whichever one that's going to lower our tax bill by the most. Getting into more specific on these itemized deductions, we're first going to talk about medical expenses. The IRS allows us to deduct certain medical expenses that exceed 7.5% of our adjusted gross income. So, examples of these expenses that we incur are our doctor or dentists, surgeons, chiropractics, psychiatrist fees, any prescription medication that we're taking, if we use any medical equipment, the fees on those, hospital services, and any long term care costs for anybody in those situations. Additionally, and one often overlooked part of that deduction is you are able to deduct the mileage to travel for medical care. So, if we're traveling long distances to get to the doctor, or we're going frequently, it's certainly a number we're going to want to look at to be able to take these medical deductions. The other qualifying information here is that these medical expenses have to exceed 7.5% of our adjusted gross income to be able to qualify. So, the example I've kind of put on the side here is we've got John and Sally who have a combined adjusted gross income of 100,000. And during the year, they had 12,500 of medical expenses. So before we look at seeing what amount they're able to use as part of their itemized deductions, we first have to look and exclude the amount over 7.5% of their AGI. So 7.5% of 100,000 is 7,500. However, their medical expenses were 12,500. So we take the difference of the 12,500 and the 7,500, and John and Sally are able to deduct 5,000 of their medical expenses as part of their itemized deductions. As we look at the next common itemized deduction that we have is our state and our local taxes. And we can deduct certain taxes that we paid to our states and local governments. However, there is an income cap or an expense cap on this. For our single taxpayers, it's going to be 5,000 of state taxes you can deduct, or our married taxpayers, it's going to be 10,000. So, kind of a couple of different things that we can deduct as part of this. We can deduct our state and local income taxes paid. For those of us in Utah, this is generally what we do is we deduct the amount we're paying to Utah. Or In different states, Wyoming being one of those without a state tax, you can actually deduct the amount of sales taxes that you pay. So when it's income tax, those amounts that you can deduct as part of your itemized deductions are going to be those withholdings that you had out of your W-2, any estimated payments that you paid, and also that amount that you paid as part of your prior year tax due. If we're in a state where we're looking at sales tax, there's a couple of ways that you can do it. First, you could actually hold on to every receipt for the year and see how much you actually paid in sales tax. That's pretty challenging. What most people do is the IRS has provided tables that approximate what the sales tax that you've paid. So we would use those amounts to include in our itemized deductions. Additionally, we can do our property taxes on our primary and if we have it a secondary home. Lastly, in some states, we can actually do a personal property tax as well. So this often looks like car registration fees. In Utah, our cars are based, our car registrations are based on the year of the car and not the value of the car. So unfortunately, in Utah, we can't use this one, but for other states, they can use their car registrations as part of their itemized deductions. So again, kind of a simple example here for John and Sally. John and Sally paid $3,500 of property tax on their primary residence. They paid Utah $4,000 in their paycheck withholdings, or what's shown on their W-4 form. And then last year, they owed the state of Utah $250 to finalize their prior year tax returns. So we can see for John and Sally, if we combine the three numbers, $3,500 in property tax, $4,000 in those withholdings, and what they paid off for last year's taxes, $250, they can deduct $7,750 in state and local taxes. For our mortgage interest deductions, we can also reduce our income by the interest that we paid on our loans. So we can deduct our mortgage interest, any points that we paid on closing a loan, and even interest on our home equity loans or HELOCs if that HELOC was used for home improvement. Also, and one that I see a lot of people not consider is you can deduct the interest on your primary and secondary homes. Many of us don't have a secondary home, but some of us do have an RV. So that loan on any RV could also qualify as well to be included as part of the mortgage interest deduction. So again, our example with John and Sally, they paid $6,000 during the year to Mr. Cooper for mortgage interest on their main home, and then additionally they did have an RV loan with $400 of interest. So as we combine the two, they have a $6,400 mortgage interest deduction that they can use to include on their return. Last really common itemized deduction is our charitable contributions. So any donation to a qualified charitable organization are deductible. Couple of the rules on it, they must be voluntary and must be as part of without receiving goods or services in return. So really easy things that can be deducted are our cash donations, as well as non-cash donations, right? Those goods that we're donating to Goodwill, Deseret Industries, or others can be included at their fair value. Those non-cash deductions do require substantiation if over $500, and if they're over $5,000, they do require an appraisal. We can also deduct if we donate stocks or property to a charitable cause. We can deduct that at their fair value. And then another one I see missed, especially in Utah where we have a large amount of volunteer work and mileage put in, we can deduct mileage driven for our charitable contributions. It's not a large deduction, but at 14 cents a mile, as we're driving groups and youth groups around, a good item to track your mileage for possible use in your itemized deductions. A couple of things to just note that are not deductible that sometimes get confused. All right, any political contributions not deductible as part of a charitable contribution. as well as, unfortunately, donations to individuals directly. Many times we think of those as like our GoFundMe's. Those are not deductible as they're not contributions straight to a charity. So for John and Sally, they donated $500 in cash to their church, and they donated $250 in goods to Deseret Industries. So for John and Sally, they're going to have a $750 charitable contribution that they'll include as part of their itemized deductions. Lastly, and this is not one we see often, especially in Utah, but we can deduct certain casualty and theft losses. I'm going to stay really high level here, but if we are in a federally declared disaster area and we incur losses that are unreimbursed, we can deduct portions of those costs as part of an itemized deductions. There's a couple of rules behind it. There's a deductible of $100 per event, and it has to be above 10% of your AGI, but can be deductible in certain circumstances. So John and Sally were in a federal declared disaster area, had a fire come through their home, it cost $20,000 in damage. So they're going to be able to deduct, as you can go through the math on the screen, $9,900 of casualty and theft losses as part of their itemized deductions, subject to the 10% of AGI and that $100 per event deductible. So now, as we've looked and seen for John and Sally, what looks better for them? We've got the individual items here on the left, and as we total those at the very bottom of the screen, we're showing $29,800 of itemized deductions. If we go and we look at the standard deduction, based on filing jointly, John and Sally are able to deduct $30,000 as part of their standard deduction. So in this case, John and Sally are really close on the itemizing, but in this scenario, the standard deduction is still larger, and they would want to take the standard deduction to reduce their income and the tax they pay by even more. A couple of recommendations that we see in this space often is to consider bunching or combining deductible expenses into one tax year. Oftentimes we'll see this with charitable contributions. Some people will go a year without paying any charitable contributions. Then in the subsequent year, they would make charitable contributions of what they would generally do in 1 year. They'd double that and do 2 of those in 1 year. With medical expenses, sometimes that's possible, to maybe combine surgeries or other things into one taxable year. Other times those medical expenses are a little more challenging. The important thing to remember is that we want to track those eligible expenses. We want to keep receipts, mileage logs, donation letters, so that not only as we prepare the tax return, but in the event that we were ever questioned or audited by the IRS, we have that substantiation and documentation readily available to answer any questions that were given. So kind of as we recap, our itemized deductions help reduce our taxable income. We'd only want to itemize if those deductions exceed the standard deduction. And if, like John and Sally, you're close to itemizing each year, it might be worth doing a little tax planning and combining expenses into an individual year as opposed to into a single year as opposed to paying it over 2 years, so that 1 year we would take those itemized deductions as they're higher than the standard, and the next year we would take the standard, kind of maximizing any potential tax that would be due. So this was itemized deductions. If you have any questions, please feel free to reach out and contact us. We would love to review any additional questions that you have.